Thank you so much for joining us for this webinar. To start us off, today we'll be discussing a topic on financial freedom. Like in the long term, how are you able to achieve financial freedom in the long term? To join us to help us to start this topic is Ruth Njuguna, who is the General Manager at Octagon Financial Services Limited. She has worked there at various levels within the pension industry over 10 years. She has a wealth of experience in management of retirement benefit schemes. She is a graduate. I'm not able to see her background information, but I believe she'll share more details with us as we start this webinar. So without much further ado, I'll hand it over to Ruth to take us through her presentation for today. This particular segment, we've divided it into two parts. The first part is 45 minutes, which will be a presentation by Ruth. Then the last 15 minutes, we'll have a question and answer session. If you have any questions, kindly drop them in the chat box on the left of your screen. Other than that, my name is Purity Wanjiro, the Director for Accurex Leadership and Management Consultants Limited. We are a HR consulting firm. We do a lot of training, team building, and coaching, mentorship, among other things. I'm keen to discuss more about our company at the end of the presentation, but for now, we'll hand it over to Ruth to share with us her experience and knowledge in the space of financial management. Karibu sana, Ruth.
Thank you, Purity, for that introduction. Just to reinforce, my name is Ruth Njuguna. I work for an organization called Octagon Africa, and we are one of the leading pension providers in Kenya. We take care of financial needs for organizations, individuals, and even small and medium enterprises. I have a background in actuarial science, finance, and I have also worked for over 10 years in terms of managing financial institutions. Without much ado, I'll just go straight to my presentation. You will allow me to switch off my video for ease of engagement on the presentation. And at the end of the session, we shall catch up further on the Q&A. I hope all of us are able to see my screen. Octagon Africa was set up in 2007 purely for the purposes of managing retirement benefit schemes. And these are our milestones for the last 13 years in terms of serving the public. Currently, we manage assets in excess of $1.2 billion US with a staff complement of around 100 in both Kenya, Uganda, Zambia, and soon enough will be in the whole of Africa. So this is just a company overview. What we offer is employee benefits, mostly related to pension, insurance brokerage, actuarial services for the purposes of risk management, and training, which is one of our anchor subsidiary entities for the purposes of promoting learning and growth. And that's how we came into contact with Accurex Consultancy. Today, we'll be talking about achieving financial freedom, and perhaps we just understand what that concept basically means. In just a summary, it means that you are taking charge or ownership of your finances so that you have a dependable cash flow to allow you live the life that you want. It also means that you have more freedom, you have more options and opportunities, and it allows you to pursue your own personal goals. However, for you to achieve that, it definitely comes at a price. And one key quote that arises from any engagement where money is concerned is that it is a terrible master, but an excellent servant. So you have to draw the line between you being a servant and you being a master of it. Some of the attitudes and emotional drivers when we are engaging in terms of money. Some of us say it is equal to survival. So you get today, tomorrow, you look for more and all that. But do you have to be a slave? Others view it as leverage. Once you have money, you have the freedom, you have success, and you have more options available for you to engage. It is a sign of status, respect, lifestyle, and security. All of us know when you are wealthy, when you have financial security, then people are keen to listen to you. You earn the respect of people, and in terms of lifestyle, you're able to manage it. However, some of us consume money as quickly as they receive it. We get a salary on the 1st, and on the 5th, there is nothing in our pocket. So it is just a cycle of hand to mouth, which we need to put a stop to it. Some think they are not worthy of it. So, I mean, I was brought up in a poor background. We always have never had money. So, I mean, I also don't qualify to have the money. Some believe it flows freely, whichever model, whether you're in politics, whether you're in business, that's what money is all about. But all of us agree that it is also the root of evil. So money can either control you, or you can control money to the extent that you have gotten financial freedom or financial literacy. And most importantly, all of us want more of it. The question is, how more is more, to the extent that we do not fall victim of greed. Before we even get to financial freedom, the life cycle of an individual in terms of planning is divided into various categories. So between age 0 to 22, you are in school, you are depending on your parents or your guardian to educate you. They are the people who facilitate all your needs to the extent that you become an adult. Between age 22 and 30, you have finished college, you are beginning to explore the world, you are learning how to make your own money, you are learning to make how to grow your career, you are experiencing everything as far as personal and financial life is concerned. The next stage is you trying to build a career and also trying to build focus. All of us at one point in life, we were brought up in a family and we would want to have a family. However, we also need to grow our career to the extent that we know where to start and where to end and where we would want to stabilize and retire comfortably. After you have had a family and career focus, you begin to build wealth. So you're focusing on accumulating either through salary, income, investments. And between age 40 and 50, the investments that you have made, the career that you have established is beginning to pay off. So you are either getting income in form of a good salary from your investment in skills, from external savings, or from other investments that you have made and are generating income. Between age 50 and 75, that's the point you are retiring, and whatever you invested for the future, you are able to enjoy it. And finally is appreciation. Beyond age 75 is we are celebrating life because we are almost going to be varied from in our discussions. One is you setting SMART goals, and we'll see how do you set those SMART goals. The time is always start investing now. Whether you're 40, 20, 30, 60, it's better late than never. As long as you just start now, it doesn't matter. Financial discipline, you learning how do you save, how do you budget, and most importantly, the elephant in the room that everyone wants to walk away from is debt management. Continuous education, how do you continuously engage yourself with up-to-date information trends that can help you become a better person in terms of personal or even financial planning? And where do you get this advice? What are your long-term investment goals? And have you thought about in retirement, in your sunset years? Have you thought about insurance to protect you in the event of an unfortunate eventuality or when you have an emergency? Robert Kiyosaki is a very well-renowned financial planner. He has written a book called Cash Flow Quadrant, and he equates it into 4 parts. So in all our life cycle or within the engagements of financial planning, there will always be 4 there will be 4 cycles that you have to achieve for you to be financially free. So the first part, we call it E, where you're active, you have just started, you work for money. So it means you're exchanging your time and effort for you to get paid. And that is where most of us start. So you have left school, you have just gotten employed, you want to get experience. However, remember, you are giving up your time to be paid. Then once you have established and you have identified how you want to move, you know your area of expertise, you become self-employed. You work for yourself, however, you don't have time. Many times when you're self-employed, because you are trying to build an entity, you will have to do 90% of the things before you can mentor other people and work on succession planning. So if you need to take a holiday for, say, 3 months, you can't because you don't have time. You have money, but you don't have the time. Then we move to being passive, money working for you. You have started, you are an entrepreneur, you have started a business, and you have people working for you to generate an income. And finally, you become independent, where you are an investor. Beyond you starting the business, you are investing in other people who are working for you, and you are basically having a good life. So that is where all of us would want. And the key item to understand is this is the quadrant that we to S to B to I. So ESBI should be your guiding factor in terms of achieving financial freedom. And just to benchmark either locally or globally, if you look at this list of the top 5 richest people, either in Kenya or in the world, none of them is employed, none of them is self-employed, 2 or 3 are entrepreneurs, but a majority fall in the level of investor. So look at them and look at their habits and also how they have grown their wealth. A majority of them focused more on creating and accumulating wealth at an earlier age as opposed to spending the money they were earning. Unfortunately, what happens to most of us is we eat up all the capital, then when we are almost finished is when we start investing the breadcrumbs. However, we should invest the capital, the return that we get on it is what we spend. So how do you set SMART goals? First, you have to state exactly what it is you want to accomplish. So do you want to start a business? Do you want, even at a personal level, do you want to get a degree, a master's degree, or a PhD? So that is a goal already. Then use mini goals to measure progress. So if it is career, you know I want to achieve a master's degree by the time I am 35. I will start with a certificate, break it down. Start with a certificate, a diploma, a bachelor's degree, a master's degree, and then eventually a PhD. So those are the mini goals that you use to measure progress. A certificate will take you 3 months, a diploma will probably take you 12 or 18 months, a degree will take you 3 years, and whatnot. Then create reasonable goals. You can't be 22, you don't have a degree, and you want to have a PhD by the time you're 30. So that isn't a reasonable goal. A reasonable goal is one that has a starting, a reasonable time frame, and resourcing to meet that goal. Then I can't be, I don't have a business, and I want that by the time I am age 23, I am driving a Range Rover. So it is a goal, however, it is not relevant for my circumstance. It has to be commensurate to my individual circumstances. We don't keep up with the Joneses. Just because someone else has it, you have to review your current circumstances and then benchmark it to what you can achieve or not. Work with timelines to achieve the goal. Most importantly is once you set up a goal, don't just stop there. Hold yourself accountable to achieve it. So if you are supposed to have a diploma by the end of the first 2 years of your life and you haven't achieved it, you need to assess and identify, why wasn't I able to achieve that goal? Is it because I didn't have resourcing? Is it because there was a pandemic? Is it because I invested too much work time? I didn't have enough time. Once you assess that within your deadline, you are able to tell why it is working or not working. If it is a degree or if it is a business, you had intended to start it within the next 2 years. Is it an issue of you not having capital? Is it an issue of you not dedicating time? Is it an issue of you, yes, saving money, but spending it not to be able to start up the business? So when you're setting up those goals, we categorize them into 3 particular categories. One is short-term. Short-term basically means the utilities, you are paying rent, you need food, you have shelter and all that. Then the basic needs over and above that, perhaps you have a car, you need to fuel, you need to pay fees and all that. The next one is mid-term. So over and above you meeting the basic needs, what are the other mid-term needs that you probably would want to fulfill? Is it career? You want to build a house? Is it a down payment? You need to categorize them. And in one of the slides, I'll be specific in terms of you achieving them. So long-term retirement, what are your retirement needs? You want to be your own boss, either through entrepreneurship or even being an investor. And the other aspect is self-actualization. So once you have achieved career success, you have achieved financial independence, are you able to give back to the community? And that's where we get to self-actualization. Generate income to supplement salary. So this would be the goals that you would want to achieve as far as financial freedom is concerned. You normally would want to generate income to supplement your salary. That is if you're employed. If not, then you want to generate more income. Then once you have generated that income, you want to preserve the capital. Yes, it is important for you to take risks, but they have to be calculated. You don't go betting with all your money. You don't go into speculative investments with all your money. You make safe decisions that protect your initial investment or capital. Then there is the aspect of maintaining liquidity. Yes, whereas you are investing, you can't invest all your money to the extent that you do not have cash to survive on or cash to pay your bills or cash for managing emergencies. A good example would be you can't put all your investments, say, in land, because if you want to get money to pay rent, you are not able to realize that money immediately. You can have various areas of investments that give you or feed into different needs to balance the risk. And that is what we call the last principle of diversification, risk management. You put your money in different forms of assets or investments so that at the end of the day, the risky ones and the less risky ones balance out. And I would use an analogy of someone eating food. If you want to live a healthy life, you can't be eating ugali and nyama choma on a daily basis. You need to eat eggs, you need to eat fruit salad, sometimes you take water, and the proportions also vary. And that is what we would call diversification. So for you to have a healthy lifestyle, you need to have protein, carbohydrates, vitamins, and for you to be nourished. And that is the same principle as far as investments are concerned. You put a bit of the money in risky investments, some in very low risk investments, some in passive investments that you don't need to follow up, but they are giving you a return. And a good example of goal setting is what I have come up with. And I will assume that this is an individual who is age 25. So you have already finished campus. Maybe for the first 1 or 2 years, you've been hustling your way out and you have gotten a job. You are earning a salary of 20,000. We have a rule of thumb as far as money principles are concerned or financial goals. The first 50% is usually for funding your utilities, basic needs. 30% is for personal needs and 20% is for savings. And I will use an assumption that we are saving 20%, which equates to 4,000 shillings in a year, or sorry, in a month. So if you're earning 20,000 shillings in a month, you are saving up 4,000. In the first year, you will have 48,000 shillings because I have taken 4,000 multiplied by 12 months in a year. The second year is 48,000, and within the first 3 years, which I have categorized as a short-term goal. Within the first 3 years, if you are a smart investor and you have been saving towards a certain goal, you will have accumulated 178,400. So we are saying this 170,000, we were saving it up on a short term for a business venture that we want to get into, just a side hustle. It could be you want to sell clothes, you want to set up an M-Pesa shop, you want to distribute a few items to local retailers. It could be any sort of business. So the first 3 years that you will have met your short-term goal. So you have capital to start a business venture, just a small one. It can be of any nature. Then the next 3 years, which will be focusing on the midterm goals, is perhaps within those 3 years, your salary will have grown, even if by 10%. And you also cumulatively start to grow the income from, or grow the income you are generating from the small business that you started. So your total income and salary within the next, after the first 3 years, we are assuming has become 50,000. So your salary grew to 30,000 and you are making an extra 20,000 from the business. And the extra 20,000, the assumption is that perhaps on a daily basis, you will be making between 500 and 700 shillings a day as profit. So your savings go up and we have 10,000. So we start to save up the 10,000. The 10,000, I got it from 20% of the 50,000. Remember, we said as a rule of thumb, 20% of your income and salary should be going towards investments and savings. Within the next 3 years, we would want to either upgrade our career, you want to do a master's degree, you want to get into a certification course, you want to improve your skills so that you can grow in your career and also improve your income. So within the next 3 years, if we save up the 10,000, then you will have accumulated a total of around 400,000. And that 400,000 will comfortably earn you a certification, a degree. And remember, every year you save is equivalent to fees for a semester or two. And a degree reasonably should take you those 3 years. So by the time you are done on your 6th year, you already have your business and now you have improved on your career, which means you have added extra skill and therefore your salary or your career growth will have progressed to a higher level. And remember, your business system, you are earning a salary plus income of 100,000, and if you're saving 20%, then you are getting a total of at least 20,000. So 20,000 for another 4 years will be equivalent to 1 million shillings. And we move to our third goal, which is you probably would want to start building your house, or you want to acquire property for the purposes, land for the purposes of building. 1 million is enough to either get you a deposit for a mortgage if you are able to access it, funds or acquire land for you to start thinking about building. This is a very clear and simple example of goal setting. So we started with your 20,000 shillings. We built up for the first 3 years to get income to start a small business. We moved to the second goal, which is midterm career. We saved up money to take us through another degree or a certification course that would move us from our current level in terms of employment to a higher level where we get more exposure, we get a better salary. And therefore, after the 6 years, we move to longer term goals where you are saving up money for land or buying a home. So this is a simple example that anybody can use. One, it is specific because you know the salary that you have been getting, you know how much money you are saving. It is measurable because at the end of 3 years, we'll be asking ourselves, have I saved up the 178,000? And if not, why did I not save it? It is reasonable because we have used an example of someone who started earning 20,000, they moved to 50,000 and 100,000 within the first 10 years. And the expectations out of it are also reasonable. And we have clear timelines that we would want to achieve this. So anytime you're setting up a goal, that is what you should have in mind. When we say you have to start investing now, we are saying that your financial choices at any point in time are not in isolation because they have a cumulative effect. When you limit your expenses, the extra cash probably goes to pay your debt, or the extra cash goes towards investment. And that's how the financial choices have consequences on each and every decision that you make. So what is smart investing? You might be thinking you are young, you don't have money, there are no options for me. You don't always need a lot of money for you to invest. There are circles, there are chamas where collective contributions help you to grow. You can even borrow a loan for you to be able to improve on your either investment or set up a business that gives you income that you use to pay off the loan that you have taken. You can put money in the stock market. And these days, because everything is automated, you are able to trade online. You can tell yourself every month, I will be putting in 1,000 or 500 shillings for the purposes of making a return. Once you have accumulated enough money, the minimum amount of shares you can buy or stocks you can buy is usually 100 units. So if a share is say 5 shillings or 7 shillings, in a period of 2 or 3 months, you have the first lot, and then you build it up over a period of time. We have talked about land. That's like a 5-year and long-term goal where you would want to buy land, then move to building. Or alternatively, you can even buy land and make it useful. Unfortunately, most of us buy land and don't make use of it. So you can also start a business, a side hustle, improve on your professional skills. Once you have improved on your professional skills, they either expose you to more opportunities, or you also use that professional skill to gain income. If you are an accountant and you are skilled, you are a CPA, you have a certificate, you can offer audit services and they are able to get you money. However, if you are just a BCom graduate, you cannot sign off in a financial statement, which means you have to invest in your professional skill for you to be able to get to move towards one state to another. Then finally, there is pension and insurance. These are long-term. Insurance is aimed at protecting you. If you don't have medical insurance and you become sick, it means then you have to go back to your investment, take out the money that you have been saving to fund an emergency. Yet, if you had purposed to pay for medical insurance in installments over time, then it would have been very easy for you to use that medical insurance to cover your expenses. The same would apply for a car, to a business. Pension, on the other hand, people say our generation say we are too young to start now. But when you say you are too young to start now, remember the future is when you need to use that money. So you start now so that you can be able to accumulate more money for the future. You can do it as an individual. You can do it as a group. There are so many alternatives that you can use to make that decision. And I talked about the budgeting principle of 50, 30, 20. So the first 50% goes to utilities and food. The next 30% to personal use, either career or emergencies. Then 20%, we have already outlined how we are able to set a SMART goal and achieve it using the 20% rule in terms of either savings, or you can use it if you have saved enough, you can use the income from the investment to fund a debt obligation. And the next one, I say the elephant in the room that all of us want to run away from, is debt management. Debt is not necessarily a bad thing. The question is, what are you using that debt for? And yesterday I was looking at the newspaper, the Business Daily, and statistics indicate that Fuliza loans have hit 1 billion daily during COVID era. So within the last 6 months, between March and now, 1 billion daily is what we Kenyans are borrowing. So the growth of it is 100% compared to a similar period last year. Last year, between March and October, Fuliza was at around 500 million. So you can see the effect of what debt does to you. We understand that the economy has shed more than 2 million jobs within the last 6 months. And of course, the youth would be the first ones to be impacted. But that needs to make us wake up. So it is never really about being employed. I showed you the cash flow quadrant, and no one who is an investor or an entrepreneur there has been successful. No one who is employed or self-employed has the ability to achieve financial freedom. So we need to start thinking beyond, can I get employment? Can I be self-employed? And look for opportunities of how to make that a reality. I'll still use the same example of Fuliza. We might assume there are small amounts of money. However, the compounding effect of what the devil is always in the detail. So we are looking at it as, yes, I'm borrowing 100 shillings. At the end of the day, then I will just have paid 1% on it. If you are paying 1% daily, it means at the end of the year, you will have paid 395% interest on that investment. So if you invested 1 shilling and you are on Fuliza for a whole year, it means then you have paid 395 shillings as interest on that 1 shilling. Which means if it is 1,000 shillings at the end of the year, you have paid 39,000 shillings on that. Have you seen what time does to the value of money? And have you seen why you have to be focusing on the devil who is in the details? Because you are looking at the 1 shilling, the 100 shillings I am borrowing from Fuliza, but at the end of it, it becomes a monster that you are not able to control. And the statistics further say that the default rate on M-Shwari has risen from 1% to 8% on a monthly basis because of the current challenges that people are experiencing. So how do you achieve independence from debt? I said debt is not a bad thing. And an interesting quote there is, the only person who sticks closer to you in adversity than a friend is a person called a creditor, because they keep feeding you, they give you a bait. So if you are not someone who has financial discipline, then you just keep sinking and sinking, and one day you are at the bottom of the ocean and there's no turning back. So debt, the first key important aspect is tracking. Know who and how much you owe. Some of us here, uko na Tala, uko na M-Shwari, uko na KCB, These days, there are all forms of credit, especially in terms of mobile lending. So it is important you know how much and who you owe. There are those debts that you can pay faster, or you can decide, let me consolidate them for easy engagement. Remember, the longer you have a debt, the more interest you pay on it, and the more it is going to terrorize you. So if you're in class and you're always receiving a call from the bank, do you think you can be able to study? If you are doing business and you are being followed up by creditors all the time, you don't give your business enough attention, and all the profit that your business makes goes back towards the repayment of loans. Never fail to meet your debt obligations unless it is very necessary, because the more time you waste trying to, the more time you extend that debt, the more punitive it becomes for you. And anytime you have extra funds, you have gotten a windfall, someone has sent you money, you have gotten a monetary gift, why don't you commit, say, for every windfall I get or for every gain I get, 30% of it goes back towards the repayment of my loan so that I get rid of it very quickly. And most importantly, stop creating more debt. Debt is also psychological. The moment you have one and you know you have a credit card, you can easily get the money, you become consumed by it and you lose focus. So I said, importantly, track your debt, know who you owe and how much at any point in time. What you feed your mind is exactly what you benefit. So read appropriate books. I've already given you one, the cash flow quadrant. I'll give you another one called Think and Grow Rich. It is not just about reading the book, it is also implementing the principles of smart investing as a result of the knowledge that you get. Listen to relevant podcasts. There are so many financial advisors. All of us are in the digital age. We are connected. These things are in WhatsApp, Facebook. You can get them wherever. You have access from financial institutions you have invested in, whether you are putting money in a bank, in an insurance company, they always have forums where they share information. They even share with you material. You can always go to their website. They have posted all manner of information that can be useful for you. And then, can you also invest in low-cost financial planning options that are available? So you can take a tutorial, pay some bit of money. It could be online. You can even pay a financial advisor, and internet sources are inexhaustible as far as information is concerned. The Forbes magazine outlines 8 levels of financial freedom. The first level is not living paycheck to paycheck. So rule number 1, which we have also established on the cash flow quadrant, is that for as long as we are living on the paycheck, we will not attain the level of financial freedom that we want. At any point in time, once you have stopped living on the paycheck, ensure you have enough money to quit your job. For a while, you should always, at any point in time, have savings equivalent to 6 months of you not struggling to borrow, to ask for help. Sustainably can take care of you for 6 months while you are trying to set up a business, or you have set up one and you are waiting for the returns to flow in. Level 3 is where you have enough to be financially happy and still save. Freedom of time. Remember, when you're financially free, it means you have more time on your hands. So you are paying others so that you can save your time. And when you have time, you have more options and you are more happy to do other things. Enough money for a basic retirement. So if you get to the age of 40 and you feel like, I am exhausted, I can be able to let other people run my business and I get the returns from it. Actual level 6, enough to actually retire well. Level 7, enough for dream retirement. I think 2 weeks ago, I watched a documentary where Chris Kirubi was being interviewed, and I would want to get to a level of that dream retirement where you are just in your house, you are able to enjoy, go on vacation without you having to struggle to think who is going to give me money, who is going to maintain me. And then level 8, which is on the higher side of investment, is more money than you could ever spend. And then finally is this information is only useful if we implement it. So the first step is for you to assess your current situation. Where am I? What are the things I have been doing wrong in terms of saving? And I would give a very good analogy so that anytime you think about investing, you think about it. When you want to take a trip, say from Nairobi to Mombasa, you have to have a clear roadmap of where Mombasa is. How many kilometers? What is the amount of fuel? How many stopovers do I need to make? Do I need to eat lunch? All those things. Is my engine okay? Do I have enough oil? In the event that I get a puncture, do I have a spare tire? So all those are the actions, or those are the mini goals that feed into your bigger objective. So you have assessed, you want to move from Nairobi to Mombasa. So set the goals. What do I need to do for short term, for medium term, and for long term? Then create a budget. These days, there are so many apps for free that you can just download to be able to track and budget. And ensure every month, if you're going to the supermarket, you are very clear with a list of what you need to buy. Don't be an impulse buyer. So you have already mapped all your income to a certain expense. And where you go beyond that, you have to have a justifiable cause as to why you overshot your budget by 10,000. And the time to start is now. So once you have assessed, you have set your goals, you budget and track expenses, then you start investing now. And most importantly for you the principles of happy money is they buy you experiences, make it a treat that once I achieve, say, the first goal, I treat myself so that I can enjoy my financial discipline. Buy time at any point in time. If you want to be a master, make sure you are always looking towards buying time, not the other way around. Not time, not you giving up time to be paid. Pay now, which means invest now, then consume later. When you invest now the capital, the return that you get from that investment is what you should be consuming, not the other way around. And most importantly, the highest level of financial freedom is when you invest in others, because you are either sharing experiences, and those experiences are the ones that are building you. So you first invest in others, then you get a return later. I think that is it in terms of the presentation, and I'll stop there to take any questions.
All right, thank you so much, Ruth. That was very, very, very insightful, very eloquent, very articulate of you. I believe we're leaving here better financial managers, not only of our own money, but also for the money that we've been put responsible for. So we'll take a few questions. The first question came from Irene Chami. And it was the slide on life cycle. Life is not a straight line. It does not always turn out as the way we want. So does it mean we are doomed if we've not accumulated wealth or saved by the time we are 40 or even 50? That's a question. There was an interjection by Dafin where he says, Ruth mentioned that no matter where you are, start saving, start investing. So what is your take on that?
I agree. Time, or rather life cycles, is not what we anticipate for it to be. The question is, when you're very clear and you have set goals, you know, I want to achieve financial freedom by this time, you are able to save up for investment. And I gave a very good example of how you set your goals, how much you invest. For instance, if an eventuality was to happen and you had insurance, then it takes off the burden that you have. if you have an emergency and you have been saving for the last 3 months, then it means you have money to cover for that eventuality. And many a times when you don't budget, it means that when you get a call from the village, you have enough money to give every other person, and it eats up your income. So goal setting is the most important. When you are clear, where am I? What do I need to do and in what period of time? You realize that it becomes much easier for you to achieve what you want. And goals help you to figure out a map towards where you are going. There are risks in the process. There are so many things that will occur in the process. But when you have the goals clearly mapped out, you know that if I wasn't able to achieve in the first 10 years, then these are the mistakes that I made, and this is what I need to do for it to become better. So it's just about planning. I realize that we make excuses on the income that we make just because we didn't plan.
Yeah, true. Also, I'll take another question from Irene. What lessons have you drawn from COVID-19 experience? Some people have lost their savings, businesses, others businesses, others have cashed in. So what lessons can we take from the COVID-19?
Very good question, and the most relevant at this point in time. The experience you have had during COVID-19, that is the experience you will have when you are at the bottom. And the questions you need to start asking yourself: have I been saving enough? Have I been investing in my skills? Have I thought about starting a business so that I'm not employed, and when my employment has been cut off, I have no other source of income? Do I have a piece of land somewhere that I have not been making productive use of it? And even the skills that you have. In fact, someone said, if within those 6 months of the COVID pandemic, you haven't learned any skill or learned anything, then you are doomed, because you had the time and you had all the freedom to either invest in a skill and all that. So that experience was for us to reflect on what we have. Right. The good thing is that most of us are young, so we have the benefit of time. Unfortunately, some people retire when they don't have anything because they didn't get the advice.
All right. Thank you, Ruth, for that. I'll take a comment from Winston Oluoch. I like that investing in professional skills that can earn you more in your field. I think that is from the comment you are making about investing in our education. Another comment from Joseph. Wow, this appears to answer many questions in our mind. What will be your advice to someone who is currently earning a gross of 50, has completed degree and no immediate plan to go for a master's? So already they have a job, they have a degree. So what's next for them?
Mm-hmm. Good.
That's
in
the
fact,
question.
Let me just populate. Yes. Let me populate that slide on the goal setting.
Yes. As Ruth gets there, we are running a poll. It must have popped up on your screen. Kindly take a minute to give us a bit of feedback on the poll that we are currently running. Thank you. Yes, Ruth, you can continue.
So this is our example of the goal setting. So this person is earning a salary of 50,000, and we will assume he is going to be saving 10,000. So within the first 3 years, because within the first 6 years rather, because this individual is not looking to advance their career, they will have at least 1 million shillings for the purposes of investing in a business. Within that period, they probably would have put this money in a SACCO, in a chama, has grown. There are so many things you can do with 1 million shillings. You can start a business, you can pay deposit for, maybe land you want to build, and whatever business 1 million shillings is able to achieve that. The good thing is that if you are very clear on what you want to save, you link it to a goal. So the first year, I want to get money to buy my stock, or I want to get money to identify or set up a shop. The second year is I am investing that money in relationships. The third year, I am investing that money in expanding my business. Then from the fourth year, I am beginning to reap the income. And even then, the better, because you are not planning to study, the income that you are getting from the business, there is some noise in the background. Even better, because he's not planning to study now, the income that he's getting from the business or from whatever investment he will be making will go towards either funding that education at some later point, or he can decide that money will go, because once you have, say, bought land, you move towards, you want to build, you probably even want, instead of building your own home first, you decide, I can build up semi-permanent houses out of Nairobi that will give me some small income that will fund another big objective of me getting a home or starting another business. There are so many possibilities that you can make with the 50,000, on condition you're very clear how much you're saving and what goal do you intend to achieve.
All right, thank you, Ruth. Yes, I believe you have answered that question very articulately. I read one more comment. I think we've answered all the questions that were there. By Winston, he says, you either grow your money, your skills, or better still, both. So thank you so much for everyone who was able to join our webinar today. We've run a small poll. The first one we asked was, do you have a budget? At 77%, our participants have said yes. So I think the 23% really need to work on their budget. Then the second question we've asked is, do you track your budget? That one was almost at 55%, they said yes. The rest, 45%, they said no. Then question 3 that we ran on the poll was, do you have financial goals? A lot of people have financial goals at 82%. They have financial goals, 22%, they really don't have any financial goals. Then number 4, which was very interesting, is debt your friend. At 52%, they said yes. So I think a lot of us are somehow engrossed in debt. Then 46%, they said no. Then have you learned something today? That was 100% we got from our respondents, which was yes. So I think there's one last question that has come from Eugene. He asked, what is 20% of gross salary? Or is it 20% of gross salary or net salary that should be saved? Remember, there's a 20% deduction of your salary. So do we save a percentage of our gross salary or our net salary? Ruth, what's your take?
My take would be, I mean, there's no point of you saving 20% of your gross salary if tax is going to be deducted from it.
Yes.
Apply 20% of the net income, the income that you already know, whether you have deducted your obligations, you have deducted obligations, I mean, not necessarily debt or rent or food. I mean, stuff like NHIF, NSSF taxes, those statutory obligations. Then the rest is what you allocate the 50-20. The question is, do you actually do it?
Yes. All right. I think since we still have 1 minute, I'll read a comment from Winston that says, just an observation, women are smarter with money because they are always looking to grow their money and money sense. Attendance today made me think this way, unless the men didn't get an invitation in the first place. No. We invited everyone for this for this webinar. I'm surprised why they did not were not able to attend. One last comment from Eva, from Eve Wangari. Thank you, Ruth. Great presentation. What is your take on student loans? What do you think, Ruth? Student loans.
I say debt. Student loan is also part of the debt management. Debt is not bad at all, for
Yes.
as long as it helps you move from one level to another. And student loans, I believe, is one of those things that you want to invest in, get greater skill and move on. The unfortunate thing is what happens is that people take student loans when they get a job, they don't pay up. Remember, it's accruing interest. And when you don't pay at the time it is expected, first, when you take, say, HELB, we are assuming you are at the age of 20, 25. And it is important you start paying it very fast before you get a family and your needs grow. And that's why student loans are structured for people who are below postgraduate level, so that you have less needs, you have more money and time to commit towards repayment. The only problem comes in when you stop paying it. So student loans are good. They help you when you don't have the money. When you're still young, you are still trying to get a skill, which is good. However, make a commitment to pay up. HELB should not be knocking at your door. You are the one who should be paying up HELB very fast, so that you can also go for another one and improve on your skills.
All right. Thank you so much, Ruth. I think that was it for today. I'll read just a few comments as we close this particular session from Esther Kirebi. Great learning here. Thank you for the presentation. I agree with Winston. Women are smart decisions. Women make smart decisions when it comes to money matters. From Sabina Njagi. That was a wonderful presentation. Though I joined late, I have learned something insightful learning here. So if you've not taken the poll, kindly take a minute to take the poll. Please remember to reach out to us if you have any questions. Also, if you want we connect you with Ruth, we are happy to do that in case you need more information on financial planning. Other than that, also visit our website. Our website is www.accurex.co.ke. You can also, just to see what we do as a business in terms of HR consulting. Also, you can drop us an email at info@accurex.co.ke, or you can give us a call at 0715-767676. I don't have much to add after that. Thank you so much for Ruth, for your very insightful, well thought presentation on financial management. I believe today we leave better people than we even came in when we were starting this presentation. We'll forever or endeavor to practice what we've learned today. Other than that, continue keeping safe, maintaining distance, wearing your mask, washing your hands frequently, and God bless you all for joining us. Make sure you join us next week. We have a very interesting topic that we'll be covering on mentoring with impact, mentoring for impact learning. So make sure you just check out our social media pages. You see more information of that of that webinar. Other than that, thank you so much and God bless you all. Bye.
Thank you.
Bye.
Thank you.